I wanted to make sure there were no perverse incentives. And if there ever was a rub, I would always, and I think this is true even as an investor, I would always fall on the founder side. But at least in this instance, I didn't want there to ever be a question if I was protecting Megan or protecting my investment.
Hi everyone, welcome to episode 130 of the Startup Playbook podcast. I'm your host Rohit Bhargava, and each week I interview successful founders, investors, and subject matter experts on how they got started, the strategies they use to succeed, and their advice to current and future entrepreneurs. I'm delighted to have Rachel Newman, the founder of Working Theory Angels, back on the podcast for this episode. I first interviewed Rachel for episode 57 back in July 2017, where we discussed her background as a managing director for Eventbrite in Australia, as well as her views on investing into startups and the ecosystem at large. Over the last 3 years, she's continued to double down in this space as a startup advisor and investor, as a board member at StartupAus, and sitting on 2 federal committees, the Entrepreneurs Programs Committee and the Boosting Female Founders Initiative. Rachel was also recently the head of startups at AWS, where I had the pleasure of working with her before she transitioned over to the AWS Leadership team. Alongside all of these other commitments, Rachel also founded and launched Working Theory Angels, a new angel network designed to mobilize investment into early stage startups and attract new investors into the space. In this interview, we covered a wide range of topics, including the importance of building trusted relationships between startup founders, advisors, and investors, how to attract world-class talent, the golden metrics and magic moments that unlock growth, what Rachel looks for to build conviction when investing into startups, and much more. Without further ado, here's my interview with Rachel Neumann. Rachel, welcome back to the Startup Playbook podcast, and thanks so much for taking the time to join us this morning.
Thanks so much, Rohit. Great to be back here. It's been a long few years in between visits.
It has been a long few years. Yeah, I listened back to our previous interview from 3 years ago now, episode 57. It's a very contentious time. I highly sort of recommend going back to that interview for those people that haven't listened to that interview before. But Rachel, for those people that may not be as familiar with your background, do you want to share a little bit about your story and what got you here today?
Yeah, sure. Maybe I'll start where I am now. So right now I'm the founder of Working Theory Angels, which is a new angel network based in Melbourne, but helping new investors across Australia and New Zealand access early stage investments. In addition, I work at AWS, where I'm on the leadership team working on some pretty, big, exciting, needle shifting things that we want to do at Amazon in Australia. Prior to that, I was heading up the startup business for them. There are a few other things that I kind of do around the ecosystem. So I'm on the Entrepreneurs Program Committee, which distributes the acceleration and commercialization grants on behalf of the federal government, as well as the Incubator Support Initiative. And I also now proudly sit on the committee that distributes the Boosting Female Founder grant money, which is a great new initiative. I sit on the board of StartupAus, and I'm a partner at StartMate. So kind of an all-around startup super fan. And then many of you guys know some of my origin stories that got me into this space and into Australia, but I was heading up a company called Eventbrite, which was a San Francisco-based startup, and I brought them to Australia.
Amazing. And obviously, there's so much that you've also left off that list in terms of your bio and things that you're involved with as well. One of the things that I do for most interviews is go back and speak to a couple of people that are close to you. And one of the things that was a common recurring theme from a lot of the people that I spoke to was, obviously you have such an interesting and diverse background. You were also a management consultant prior to kind of jumping into startups as well. And one of the things that came up as a very common recurring theme was your ability to bring in a lot of the different pieces from your background and sort of apply that to the way that you sort of work with startups or the way that you kind of structure your thinking. Is there any, insight that you can share in terms of what are some of those lessons that you've picked up or frameworks that you've utilized to help you sort of identify those things and really be able to kind of take the really complex situations and make them appear really simple?
Yeah, it's funny, that people picked up on that because that is something like I'm pretty proud of, that everyone has their superpowers. I'm not good at many things, but that's like the one thing that I am good at. And I think I'll kind of go back a few steps. I think in the startup world, especially in early stage investing or working with early stage companies, being able to have an interdisciplinary approach or multiple lenses through which you see something is really important. And that's because a lot of these companies are doing something for the very first time, or they're, coming at an industry from a completely different way. They're creating a new category altogether, innovating a business model. And so there is no playbook. It's not, I know exactly how to do this. I've seen it a million times. There is a startup playbook podcast, of course. But what I'm saying is that direct experience in that thing usually doesn't exist if it's something that's new and novel. And so when I look back, I've just always been curious in lots of different things. It's like my greatest strength and also my greatest weakness, and that I people ask why I'm not a founder. It's because I can't think of one thing I want to obsess over for the next 10 years. So, even at university, I designed my own major at Stanford and had an interdisciplinary degree where I took courses from lots of different departments. And I just wanted to see the world through different lenses. And then I wanted to see the problem from a few different angles. And I think that training, that liberal arts training, that interdisciplinary training made me really good at management consulting, where also you have a big, nebulous, ambiguous question and you have to force some sort of framework around it. And being able to come at it from a people lens, from a business lens, from a macro trends lens, helps you to start to make sense of something that is quite ambiguous. And going back to just early stage startups, you have to see it from a few different angles. And so I think my kind of advice, or what I would tell people when they often say, like, what should I study if I want to do this? And it's like everything, just like read as much as you can from diverse sources. If you looked at my bedside table reading list right now, it's quite hilarious, and just how random the selections are. But the more that you can see the bigger field, one, you can start to pattern detect, but also it allows you to come at things from different routes and be able to at least have some sort of framework. You'd asked, what kind of framework do I use? And in early stage startups, again, because it's so ambiguous, very rarely am I saying, how can I prove or disprove this? Instead, I ask the question, what would need to be true in order for this to happen? So I'll give you quintessential examples. When an early stage founder brings me, financial projections of where she thinks her revenue is going to be in the next couple of years. Now, we all know that, early on, those projections are going to be way off. They're either going to be way understated or way overstated. Rarely is it going to follow that same path. And so I'm not there to, investigate each and every number and to interrogate what were the inputs that built it up. I look at it, what would I need to believe for this number to be true? All right, you think you're going to be at 3 million ARR? What would I need to believe to be true? Well, we know the market size is this. I would need to believe that you can capture 1% of the market. Do I think that's feasible given who you are, your team, your product? Yes, then I believe that number. So I think that is the shift kind of from management consulting into early stage investment, is that question, what would I need to believe for it to be true? It's less of this bottoms up build and more of triangulating a belief set around a company or around a hypothesis.
One of the things that Bessie Graham and Paul Naftali spoke about was your sort of obsession with data. And, having worked with you closely at Amazon as well, I know how, how much importance that you place on data. But as you just mentioned, startups are, it can be really vague at the start, and it can be really hard for founders to know specifically what direction they need to sort of head in, because there are sort of limited data points for them as well. Any advice on how founders can get better at understanding what are kind of the most impactful things, or what will be the key drivers for them for their business?
Yeah, well, it's funny. I have an obsession with data, but if you look at my psychometric testing, I'm very high on intuition. But I think that I trust my intuition because I think about what is the data that I need to either prove me right or prove me wrong, and also what is the data I've collected in my life in various places that have helped me to feel a strong gut reaction here. So I don't want to overstate or understate because I mean, Rohit, you've worked with me and you've seen me ask for proof from other people many times. My joke is, in God we trust, all others must bring data. And again, it doesn't have to be data that says the answer is 5. It has to be data that says, this is what's underpinning my thinking. This is why I'm forming my hypothesis. And I want you to back me in running this experiment. And I'm like, yeah, cool. So to shift a bit to your question around what can founders or, teams think about for data for them, there's a sweet spot with data, right? Where you're looking at the metrics that matter that can actually push your business forward. If you go too far and you're instrumenting and measuring for the sake of measuring, that's what I call data masturbation. It might feel good to collect all of it, but it's not really getting you anywhere. And the more data you masturbate with, am I allowed to say that on your podcast?
Yeah, you can say that.
The more data you mess around with, the more you are going to distract yourself from what needs to happen. And quite frankly, it's the buffer that you're putting between you and your customer. So, I always think about like, what are the golden metrics, or pick 2 or 3 metrics that really matter, such that if the measurement comes out at 10, or if it comes out at 100, that means you're fundamentally going to do something different. You're going to make a different decision, or you're going to manage differently. If you're measuring something and it might swing all over the place, but you're like, oh, that's really interesting, but you don't actually do something different with yourself, then that's not worth measuring at this point in time. So that's usually what you should think about. And like, what are some of those great metrics to use? It's very specific to your business. So I often think about, because I'm obsessed with product and customer experience, I often think about, what is the magic moment in your customer journey that when she or he gets to that point, or gets just past that point, they're significantly less likely to leave or to churn, and significantly more likely to do the behaviors you want, i.e. stick around or tell their friends, pay you. And so very often I think about instrumenting kind of the moment that is just slightly before that magic moment, or that magic moment itself, if it can be measured, because that is going to be a real key driver in your growth, your customer experience, which will lead to your growth. So that, again, I wish I could say like, it's X over Y, but it actually takes some very thoughtful contemplation to say, in my customer journey, what is the moment that matters the most? And then how do we measure the lead up and the conversion to that moment?
Yeah, I was just about to ask, I think there can be a temptation, as you said, especially with data, to overemphasize the collection of data and potentially focus on the wrong type of metrics as well. For, I guess a founder who's potentially struggling with that at the moment, any advice on how they can, identify what those key metrics are that they should focus on? Is there anything that would help them sort of distill what what kind of the key drivers of that customer journey should be?
Yeah. So I'll give you 2 tools that I like to use. And sometimes it's like, I'll work with a founder or a team, and this will take a whole day. So this doesn't happen instantly. But the first thing I do is a customer journey mapping. So very simply, grab a piece of paper, turn it into landscape, and across the top, I like to do it in chevrons, because as you outed me, I'm an ex-consultant, but I kind of map out what are the big steps of the customer journey. This is not the steps of your product. This is, think about the customer and what is she or he doing before they discover your product, as they're using it, etc. So just literally like walk a mile in their shoes. Then below it, I have 2 rows. And the first row is when it goes well and when it goes poorly. I use stronger language. And you either can start to hypothesize what those are. Best is that you ask your customers what they are, or you have some sort of tool where you get feedback, whether that's NPS or any other tool that you use to get feedback, but you map it out. So what we'll end up with is this journey, and then real examples, and if you can bring verbatims from your interviews of what it looks like when it goes right and when it goes wrong. And what you're actually trying to do is get into the emotional and psychological state of your customer and say, why does it matter that at this moment, when it goes wrong, it's so very wrong? It's like, oh, because the step right after that is when we ask them to pay us. That's a pretty bad time to give a customer a shitty experience when we then ask them to give us money. Another thing can be you're thinking about what is their emotional state when they enter into that step, and what are they more likely and less likely to do. And so once you map that out, you really start to get a feel for what, like I said, the emotional and the psychological state of your customer is. And you get to see what it could look like in that moment if it goes really right and really wrong. But you see it in a system, not in a moment. And then what I do is a 2x2, because again, consultants love 2x2s. So just draw 4 squares on a page. And across one axis, I usually say like the emotional state, potential to, at Bain, we used to call it potential to anger or delight. And I do high, low and high. And then on the other axis, it's hard to give a general example, but you can think about like whether or not it is like a critical step in the experience, low, high. And then those moments that you've mapped out in your journey, you start to put it into those 4 quadrants. And so then you can think about what would you like to prioritize. You'd probably like to prioritize the things that are very critical to the experience and very high emotion. So what's in the high, that's when you'll start to prioritize that. If something is not very important to the overall product experience, and they have, a customer has like a very low propensity to get angry or happy about it, and it's in the low bucket, that's a deprioritize. And then in the other 2 quadrants, you can figure out how you prioritize. So that becomes your prioritization framework. And if you want to get super fancy and make a 3rd axis, when I plot it, I kind of make the circles the relative size of the customer group that it's impacting. And so all of a sudden you can see this visual of, which quadrant to focus on, and you look for those biggest bubbles. That's going to be the biggest population that are going to get super pissed if you get it wrong, super happy if you get it right, and it's pretty core to your experience. So that's usually like the quick and dirty tool that I would recommend to most. Map out your journey, then take those moments, put it into the prioritization framework, and that tells you what to work on.
As is probably evident to most people, you're a bit of an expert when it comes to customer experience. I was fortunate enough to sit in your Customers Queen session at StartMate, I think my 2nd or 3rd week at AWS as well, which was amazing. And, again, one of the things that Kylie Fraser mentioned, who's your partner at Working Theory Angels, is that the difference in terms of the lens when you both sort of look at investments is that you place a really high emphasis on products with really great customer experience and products that really delight customers. Do you want to talk a little bit about, from an investing perspective, why you place such a big emphasis on that, or why personally that's so important for you?
Yeah. Well, first of all, I tend not to invest in things that I can't imagine both like loving and getting excited about. And so those things go hand in hand, because products that people love are products also that I'd get excited about, even if I'm not a customer, but they're things that I'll want to talk about. And so that's what's special. When you want to talk about something because it's delighted you, you are doing marketing on behalf of the company for free. You're doing their work. So why do I love this as an investor? Because what we know about products or services that have great customer experience, they do 3 things. Customers stay longer, they spend more money, and they tell others. And so why is that the holy grail investing? Stay longer, that is, more customer lifetime value. Spend more money, that's greater share of wallet. Tell others, that's free marketing. So what happens when you're growing really quickly at a lower cost to serve? That's profit. So not only do I love these, these products, because as a consumer, or when I put my feet in the shoes of people who'd buy it, I can see why it would delight, but it makes a lot of business sense if you can let your customers do the marketing for you. The other thing that we know is that so critical to startups or to any company, it's the team that you attract to help build your company. And one of the things that we know is that companies that make beautiful products that have wonderful customer experiences are able to be a magnet to attract world-class talent. And just think about it, it's very logical, but if you are a very talented, awesome person, you don't want to work at a company where you know that the product is crap and customers hate it, and it's like super embarrassing when you tell people, I work for this telco with terrible customer experience, or you want to be really proud of where you work. And so there's this virtuous cycle that happy customers create a happy company that attracts great talent, that creates happy customers, that builds a great company. And so again, when this customer experience key is so critical, because that I think is the holy grail to growth and the holy grail to attracting a world-class team to help you to do it at lightning speed.
Yeah, I mean, I definitely want to sort of come back onto the investing piece as well, but just picking on one of the things that you mentioned, because it was also something we spoke about 3 years ago. And, we spoke about kind of the whole idea of being a magnet to attracting talent. And that's often something that comes up on the podcast is, one of the biggest challenges for fast growing companies is how do you attract the best talent to come in and work with you and kind of believe in what it is that you're doing. I've kind of gotten to see that a little bit firsthand in your ability to do that from an AWS perspective and see a lot of what you spoke about 3 years ago in action. But again, for anyone that's listening, any advice on how they can, build up that kind of magnet to help them attract the right talent?
I mean, I think I'll go back to what I said earlier around data. You often won't have data. You won't be able to say, we're this company, like, look at all this revenue, look at everything we've done, especially when you're attracting those early employees. So you have to sell them that story. Like, what would you need to believe for us to, for you to join us? And so I actually think, founders that can tell good stories, which doesn't mean lies, like truly like create a good vision and wrap a story around how the team is going to get to that vision, is going to be able to attract customers, attract investors, and attract team. I think that it's really important that early founders are extremely intentional about the company that they want to build and what kind of experience they want their people to have. And that, I was in San Francisco in that era where it was about like kombucha on tap and ping pong tables. And I think that we've gotten past that. It's not these kind of empty perks that matter. It's really thinking on an individual basis, what does this person want and need from their work life? What kind of impact does she want to have? And what kind of skills does she want to develop? And how can I ensure that she gets that? And so I think taking the time to understand what motivates individuals, making sure that's the right match, right? Because like once if I heard, Rohit, that what motivates you is very different than the experience I can give you, there needs to be a real honesty about that. One, because a mismatch hiring decision is quite costly in both of like money, time, and emotional energy, but also like you're building a relationship that in this very small community is likely to come back around. And so I think that having honest, making sure that when you're looking for roles, it's definitely a two-way street. You're both kind of ensuring that this is what's right for both sides, and having some real honesty around that. I know that also is like we're talking a very privileged position and like a very specific type of work, where people ideally have a little bit of choice and agency. So I just want to acknowledge that. But in the white collar work in which we're talking about, it's very important that people are very clear around what they can offer, and people are very clear around what they can give, and looking for opportunities to match that up. And just remember, like, especially for early stage companies, they might not have, learning and development programs or even experts on the team that people can learn from. And so leaders have to get scrappy about how they bring those things to their people. So obviously, the Princeton study shows how important learning on the job is, but, how can you tap into your network and get mentors, or how can you make sure that it's a learning and curious environment so people continue to grow? There are ways that you can kind of get scrappy around meeting people's development needs, even if you're a small company. But the most important thing there is just like honesty and making sure that it's a match. And when it's no longer a match, having, compassion on both sides to say, this was wonderful. It served a real purpose. And now I'm ready to step onto my next stone.
Any advice for on how to find what the sort of key drivers are? So if you've got a world-class talent in your pipeline that you're trying to get across the line that, is potentially tossing up between a couple of different options, what are the questions that you're asking, or how are you probing to identify what are the key drivers, and whether, as you said, that matches with what you can offer them?
I usually opt for this question. Rohit, what matters to you and why, right? So like, you can do a lot of, psychological warfare, and sometimes people tell you in subtle ways, but just say, hey, like, Rohit, you've probably sat in enough interviews that I've done. You will have heard me say, like, just tell me. I'll say, listen, I know where you are in your CV. I know your skills. You've done amazing things, but like, where are you in your journey, and what is important to you right now, and why? Just ask. And I think that people sometimes might feel a bit confronted because, like, that's a very direct question. But hopefully, they disarm and they tell you exactly what they want, and and then once they're inside the business, continue to ask that question, because that should be evolving and changing. And especially if you're in a fast growing dynamic company, that's going to change. And so, like, when I joined Eventbrite, I'll get very tangible. I knew what was important was that I wanted to try lots of different things inside that company, because I had been a consultant, but I didn't know within the company what was the right role for me. And so I don't think I told them, oh, I want to try everything in here. But what was important was that I looked for evidence within the company of people who internally had different roles and bounced around. And I said, oh, you know what it looks like? It looks like this is a company where things are moving so fast and they're growing so quickly that the needs of today will be very different from the needs in 3 months and 6 months, et cetera. And it looks like if you're talented, do a good job, and work hard, you can put your hand up and do lots of different things. And that was absolutely true. And so, like, if that is important to you, even if you don't articulate it, in the interview process, just make sure that you look for evidence of those things being present within the company. And so in my time at Eventbrite, I started out as director of customer strategy. Then I was actually in this little skunkworks teams for a while, looking at some special secret things. Then I was managing director of Australia and launched that. Before that, I launched the Nashville team. And started that office. Then I launched Australia. Then I came back to San Francisco and was kind of global strategy, looking at our overall growth. And so, in a few short years, that was like 5 different roles. And that was absolutely the experience that I had wanted there. So just, look for evidence of that being the case.
Yeah, definitely experienced that when I've sat in on interviews, but I also experienced it on the other side when you helped get me across the line at AWS as well. Again, just going back to something we were speaking about a little bit earlier in terms of relationships and building conviction and kind of the limited data points for a startup when they're sort of at the early stages. As an investor, it's almost even harder because, founders are trying to tell you a particular story around their business. How do you think about sort of building conviction for yourself when you're speaking with early stage companies? What are the things that you're looking for in the company or in the founder themselves that help give you the conviction to back or start working with that company?
Yeah, I think I just want to start out by acknowledging statistics, and like, I'm going to get it wrong. Every investment I make, I have very high conviction. And if you ask me right now, I think my portfolio, 100% of the companies are going to be extremely valuable. But statistics would tell me that that's not the case. So I just want to acknowledge that when you invest, you go in believing everyone will be fabulous. And the truth is only a few will be, but they will be so super fabulous that they make up for those who didn't pan out as intended. So I just want to acknowledge the presence of portfolio theory here, which, a small plug, like as an early stage investor, part of me mitigating that risk is trying to get as big of a portfolio as possible. In no way dropping my bar, in no way lowering my conviction, but very much managing the reality of early stage companies and the relatively high death rate that occurs. So, the first thing I do is I make sure that I'm, conducting my investment safely by making many of them. The second thing around how do you get high conviction? So there are 3 questions that I always ask myself. The first one is this a very clearly articulated customer problem? Second, is it in a large and growing market? Third is, does this founding team or does this team have some sort of unfair advantage or ability to tackle this customer problem in this large and grow and seize this large and growing market better than anyone else that I know? The fourth thing that I have like this little asterisk 4th thing, and that's like what I call like secret sauce. And that is, I've come to learn, and I've just, spent quite a bit of time rambling with you about like amazing products and customer experiences. At a certain point, an outstanding product becomes a hygiene factor, and you need to have some sort of special sauce. And that is, something that will that makes the investment. All right. So I'll get tangible. I remember a long time ago in StartMate, we had a company called Delishu that made bacon seasoning. Now, Delishu is an amazing company, not because it can make powder that tastes like bacon. They're an amazing company because they figured out how to acquire customers on Facebook like nobody's business and get everyone to come back and buy twice. That was their power. Like, that's their power. You know, I recently invested in a company called StartupAus that uses AI to teach Chinese children how to speak English. And I mean, yes, they have a wonderful product, great AI, great user experience on the app, but their special sauce is how they have figured out how to acquire customers through WeChat at cents, and specifically they figured out which tiered cities in China perform best, and they're able to use WeChat as like this customer acquisition funnel, and then they've figured out how to make the product so sticky that they are extremely likely to get up to, they're like at the 8th conversation. So they have this amazing stickiness. Like, that is what's magic about it. So I'm always looking for, what is that special sauce? What is that magic? And sometimes I'll just ask the founder, and sometimes I believe her, sometimes I don't. Sometimes, he says something that is, something I wouldn't have even seen. Sometimes he doesn't, but I am looking for that. And at the very least, asking that question and having that conversation helps me to see how big or small that founder sees the world. At Amazon, we talk about that, thinking small is a self-fulfilling prophecy. And so sometimes when I ask them, what is the special sauce? And that's when their eyes usually light up, and when their brain kind of goes crazy and they usually come up with something. That's where I can kind of see the magic and the excitement and the motivation. And it's usually that in that moment and the discussion around that topic that sells both of us on me wanting to invest and them seeing me as an investor they want in their cap table.
Speaking of being an investor on a cap table, I also spoke to Jeremiah and Megan, who are two of the founders that you've backed. Again, one of the things that was a commonality between speaking to both of them was, among other things, we're really good at keeping them both accountable in a really positive way in terms of helping them think big, but also just making sure that they're focusing on the right things. Often there's a lot of conversation in terms of how to get angel investors and how to get advisors on board, which I'm sure we'll speak about. But I guess from your perspective, and I guess having played both roles, what should the role for an advisor or an angel investor be in a startup in terms of the support that they provide, or what should founders be looking for to bring, again, the right people on board?
Yeah, I think that the answer is less your role is this. And the answer is, be very clear that both of you agree that your role is this. So if you think you're there to give them product advice, make sure that they see you as someone that they want to get product advice off of. Likewise, if they see you, if you see yourself as there to coach the founder, make sure that she or he is receptive to being coached by you. And so there is this consensual conversation that needs to happen. And so one of the questions I always ask, if we're kind of getting into a more active relationship, is in your mind, what is the role that you see me playing? How frequently do you see me playing it? And what would this look like? And how would we be able to let each other know that it's, going well or not? And then I can say, hey, that thing that you think I do, I actually don't do that. Or I can say, hey, that expectation that you have around the frequency, that's realistic. But you need to actually have that conversation up front. So I think that, and that's where founders need to take the time to say, who is this team I want to amass around me? Sometimes by giving them equity, sometimes by taking their money, but who do I need around me? And what are the skills or the experiences or the networks or the type of personality that I need? And be very thoughtful. You are building a team. You're not just plucking individuals. And get that balance right. You don't want a full team around you that all rubber stamp you, but likewise, you don't want a full team around you that's going to be up your ass about everything. So really, find the balance, find the skills. Bringing together advisors, it's the best way to get the talent into your team that you can't right now afford or attract. So use it wisely And the thing about advising is that it's okay if that relationship is short-lived. It's okay if, like, right now they need me to come in and help them think about system, right? And in 18 or 24 months, they know how to do that. And the major issue for their business is something very different, and they should find that person who can do that. So advisor agreements, usually like when they're formal agreements, should have an expiration date. You gave me two examples. So Jeremiah is one of the founders of Muso, which is an amazing company that I love being part of. He founded that with Alan and with Brandon, and they're a great team who are helping to connect musicians with venues who are looking for live music. Big plug for them, because during this COVID time, when the core use of that product might have been diminished, they've been hustling, and they landed some massive deals, so that when live music is back, they're well set up to just totally dominate. And then you mentioned Megan, who's the founder of Bellish, and Megan and I have a different arrangement. She is the only person who I advise who I have not given money, invested money in directly. And that was a very intentional decision. I hope she doesn't mind me talking about this, but the role that I play with Megan is very much working with her and making Megan the world-class CEO that she already is and that she's going to continue to become. And because we have that relationship, it's not about me talking about product, although sometimes we do, not talking about, growth strategy, although sometimes we do, because it is so much about her, and it's about me being in her corner and building her up, holding her accountable, but holding her accountable to grow into the powerhouse that she already is and will continue to be. I wanted to make sure there were no perverse incentives. And if there ever was a rub, I would always, and I think this is true even as an investor, I would always fall on the founder side. But at least in this instance, I didn't want there to ever be a question if I was protecting Megan or protecting my investment. And so that's kind of an experiment. That's the first time, because I like to put money in, one, because if I have strong conviction, then I want to be part of the ride. Two, I want to show the world that when I back a team, I put my money where my mouth is. And three, I only spend time with founders that I love. And so chances are they're building a great company. But Bellish is my first experiment in having this like deep and intimate relationship with the founder on her individual journey and not investing. That was a long-winded answer. I'm sorry.
No, I was actually going to follow that up because, I spoke with Megan specifically around this, which was she mentioned that you didn't invest and you kind of approached her with this idea or this experiment, as you put it. And she said that she really valued that because it means that she can have very honest conversations with you that she can't have with other board members or kind of in other areas. And, I think when you think about an advisor perspective, like that's really what an advisor should be for a founder as well, is someone that you feel like is on your side more than anything else and there to really help you. But as you said, sometimes it just gets a little bit conflicted when there are differing opinions and when you have fiduciary responsibilities, especially if you're looking at it from an investment perspective as well.
Yeah, and now that I'm, kind of investing with other people's money behind me, that shifts. My relationship with Megan has been one of the greatest gifts that I've gotten from my startup experience. I mean, all the founders that I work with are amazing, and I love them all. But this role that I'm playing with Megan has been very powerful for both of us. I hope that, she has taken as much from the relationship as I have. To your point earlier around keeping people accountable, sometimes that's, Rachel Tough Love Newman, as Tip recently called me at the Blackbird thing. But sometimes it's me saying, Megan, hang up the phone right now and go for a walk. Like, your head's all over the place. And what you really need is to take a break. I had another founder who I spoke to on the phone recently, who I've known for forever. And she was kind of burning out and she wanted help making some pretty big decisions that were going to be one-way doors. And I said, you know what? You can't make these decisions right now with your state of mind. And I was like, come up to Byron. She lives in Sydney. I was like, come up to Byron for a few days, chill out. When she was here, we had a coffee. I then told her to go home and paint her house. She thought it was going to be 5 days. It was 3 weeks painting her house, which was very like Miyagi-san. and she has like a lot more clarity on how she's going to make some of these big decisions. So accountability isn't always like, you said it was 5, why are you at 4? How do we get you there? Sometimes it is, but I think all the founders who have worked with me have heard me at some point say, like, you need to look after yourself right now. Like, stop what you're doing, go play basketball, go for a walk, take a few days off. And quite frankly, if you can't take a few days off, you haven't built enough redundancy into the system anyway. So it's always a good thing to do is when you step out, you look at what breaks and then you figure out how to fix that, so that the world doesn't revolve around you. That is a very risky investment for me. If one person can't step out and the world stops turning on its axis, that's too risky. So there's a good exercise in that, in addition to taking care of oneself. This is, very much a marathon and not a sprint. And we need these people to finish intact, as spiritually, emotionally, physically intact, not because it makes her a better investment, but because that's what human beings deserve to feel like at the end of this. So it's our job as investors, if we think we're going to make money off of these people and their ambition and their great ideas, then it's our fiduciary responsibility to take care of them as well.
Yeah. And I know that for you, it's not just a financial thing. I also experienced that with Amazon when I think you told me not to go to the US for another trip because I was just traveling too much as well. And your words to me were exactly, it's a marathon, not a sprint, and you don't need to kill yourself over this.
I can say that with great wisdom as someone who has broken herself many times. So it's a little bit of a do as I say, not as I do. And I'll be the first to admit that we all have these little beasts inside us, right? And we often do things that feed those little beasts. And we could either feed the beast that knows to take a break and to take a walk and to prioritize family. But then we also have this beast that is often externally motivated and is fed by accolades and progress and tangible outcomes. And so I admit that there have been many times where I have fallen prone to that. And the great challenge is to find the balance. And I can't say that I'm there all the time, but I'm there more often than I was. And unfortunately, it took getting to the edge for me to realize that I needed some balance. And of course, because I'm, dumb, I didn't get to the edge once, but, twice. So I just encourage people to, really think about finding that balance sooner rather than later, because it feels much better when you have it. That's for sure.
Absolutely. And, I think especially working with startups, it's hard not to be at the edge a lot of the time. There's a lot of different kind of moving parts. There's a lot of stress. There's a lot of things kind of moving and breaking very, very quickly. As you mentioned, it's potentially a little bit easier for someone like you to be a step removed from the founders and say, hey, I think you need to go paint your house or come up to Sydney for a little while. For someone who doesn't have the good fortune of having you there to give them that advice, what are potential signals that, you look for when you're speaking to founders to help you advise them to take that step back?
Yeah. I mean, there obviously there are physical symptoms, when people are struggling with their sleep or eat or having trouble with relationships, not prioritizing their physical health where they used to, those are big red flags. But you can actually see it. You can just see the clarity of decision-making gets really muddled. You really can't, what we talked about earlier, where you see the whole field, you're looking at it through multiple lenses, you're collecting data from multiple different sources, you're trying to synthesize information, get clarity, or at least have a strong hypothesis. When I see people start to spin, when, it takes them a long time to just process, to be sharp, you can just see the brain can't cope with that amount of stress. And that's because we've, pumped it with cortisol and with adrenaline, and it's actually fatigued. It's exhausting. I had a coach call it battle fatigue. And that's what it is, right? What happens is we put ourselves into the startup battle and we're at war and we're roaring around, yeah, this is great. And it feels amazing. And then all of a sudden you're like, fuck, I am. And even if you can't see those signs, I am deeply exhausted, the people around you, if they know you, they can see right, why can't you make a damn decision? Or, why did you have to look at this data 5 times before you got the insight? Or you missed that. And so your business, your team, you will suffer if you don't take care of yourself. If a high performance athlete did not take recovery time, and did not look after her or his body, not be able to perform on the business field because they haven't been taking care of themselves. So it is very much a thing. So if you know someone and you just see this like cognitive fog, that's what it looks like. They are foggy, where they used to be laser sharp. Be a good friend, or be a good investor, be a good teammate, and say, like, how can I help you to replenish? Because this isn't working right now.
Yeah, it's an amazing takeaway, and I hope that everyone listening takes on that advice. Rachel, given the time, just want to make sure that we kind of cover off on what we've spoken about a few times, but working theory angels. Again, for those people that may not be as familiar with working theory or how it works or what you're looking for, do you want to share a little bit about the group?
Yeah, sure. So it was very exciting to launch this new angel group in the middle of COVID, which is not usually when you think about investing in early stage startups, but actually it was the perfect time. And so, but it was a long time coming, Rohit. And 3 years ago when I was on this podcast, we talked about 500 startups. A lot of my hypotheses and underlying investment theses then are exactly what I'm doing now, just with a different vehicle. And basically what I wanted when I looked out, and as I became more active as an early stage investor, lots of people were coming to me and they're like, how do I get into this? I want to learn. Where do I go? Blah, blah, blah. And so I was like, okay, there's obviously a bunch of people. There's a market mismatch, because there's money and people want to get into early stage investing, and there are founders who need capital, and we just need to get them into play. So one was, how do I attract more people into the space and do it safely so that they have the confidence and the competence to invest? The second part is, if they feel like they know what they're doing, how do they have access to the deal flow and great investments? Because listen, for me to write 10 checks a year, it means I'm meeting somewhere north of 700 to 1,000 companies during that time. You have to kiss a lot of frogs to find those investments. And most people don't have access to all of that deal flow, nor do they have the time to go through, to manage that. And then the third is, if they're doing their job as an early stage investor, getting a big portfolio, not in quantum of money, but a number of companies, they're writing small checks. And the question is, if it's a great hot deal that they manage to find, are they willing to take a small check? So Working Theory was designed to bring and attract lots of people investing into the space. So it's cohort based. We have about 30 people in this cohort. They fall into 3 buckets. The first one is amazing founders with successful exits who want to either give back or learn how to invest. The second bucket is actual investors, whether it's a partner in a venture fund or high net worth individuals, but investors that want to place small bets together early stage with something that they could potentially lead in the next round. And then the third is folks who are outstanding in their fields that are not tech and startup. They might be in the corporate world or medical or legal professions, and they want access to this asset class and want to learn. So we've brought together 30 some odd amazing people. We learned together. So Kylie Fraser, my partner at Eleanor Ventures, and we handle all the pipeline management. We do all the due diligence in an open way so that our angels can learn and watch and participate behind the scenes. We then invest in 10 deals across the course of the year. So we've pre-committed a certain amount. We evenly divided over 10 deals. And so what that means is I can feel comfortable, sleep well at night, knowing that when the angels are done with that 1 year stage 1, they have a portfolio size of at least 10. They've learned how to do the due diligence process, and they're ready to kind of be street legal. Of course, then we have the power of coming in as bigger checks. We spin up into one line in the cap table. And because all of the angels have pre-committed a certain amount, I have the confidence of knowing at a minimum what size check is going into each deal. So founders love that because we can act quickly and have transparency around what the investment is going to look like. So it's been really exciting. It's been a wild ride. Like, it's been so much more fun and more successful than I thought it would be, especially during this time. And the best part has been the incredible founders that I've met along the way. We are kind of working on our third deal now, but boy, I think we have enough lined up that by the end of the year, we will have, 6 or 7, maybe even 8 deals done and dusted. So it's going to be a very busy back end of the year.
Very exciting. Just before we shift over to audience Q&A, so just a quick reminder for everyone that's tuning in live, if you have any questions, Rachel, submit them via the Q&A tab. Rachel, for anyone that wants to apply for funding via working theory, or if anyone wants to become an investor via your second cohort, whenever that happens, what's the best way for them to find out?
So second cohort happens in February. Obviously, we're looking to meet companies all the time. So just head to the website, workingtheoryangels.com. In the contact us, there's just a quick form. Just say if you're an investor or looking for an investment, just reach out, say hey, and then we'll pick it up from there.
Perfect. All right, I'm going to shift gears and move over to audience Q&A. So the first question that I'm going to pick out is from Bryce Chi, who says, super appreciate the focus on the early stage of things, Rachel. Was wondering if there was a particular focus or thesis for Working Theory Angels.
Yeah, so we are industry agnostic at this point. And if I think about like what is the pipeline of deals that we're likely to do this year, we have, I mentioned one that is kind of AI in education language. We have another e-learning thing we're looking at, 2 ag tech, 2 fintech, 1 crisis and disaster management company that we've invested in. So 2 life sciences. So kind of all over the place. Again, if we go back to what do I ask myself when I look at investment is clear customer problem in a large and growing market. And what we're seeing is those large and growing markets are falling into these buckets that are not a surprise. It's, it's around how do we sustain ourselves on this earth? So environmental questions, how do we live and work and learn in a very new reality? So that's around, cloud-based learning or tools, SaaS tools. And then it is, how do we feed ourselves with ag tech? So things are falling into those kind of big human issue buckets right now.
The next question that I'm going to pick out is from Ram Hemige, who says, when is the right stage or time to find an advisor for your business?
So you can always find advice without finding an advisor. And I find myself giving lots of advice without having formal advisor agreements. So I think it's it's whenever you say you are ready for that, right? Like it can be a very deep and powerful relationship. It's when you think that there are skills or assistance that you don't think that you can build yourself, or you want to fast track getting somewhere and you think that a human can help to be that hack. Or if there's a skill set that you really want on your team and you can't quite, afford the talent that you want and need, then advisors are a great way to hack that. But like I said, just remember advisors have expiration dates. So don't go into it with too big of an expectation for how long it will last. But likewise, don't walk in lightly, putting someone on your cap table, because even though an advisory agreement might be short-term, a stock agreement can last forever. And so really look for the humans that you want to surround yourself with, the right people who have similar motivations, similar values, similar ethos.
Can you, just to dive into that a little bit deeper, can you share from an advisor perspective, when does it make the most sense for you to formalize a structure, and any sort of advice in what the structure of that should look like from your perspective?
Yeah, so I'm doing it less and less, I'll be honest, because I am investing more. So it's really just about me looking after my portfolio, and it's becoming less formal and more just 50% of my time should be just taking care of my portfolio, reaching out to everyone, having a chat. So I have a monthly chat with most of my founders, some more frequently, as we discussed. But I don't enter into any agreement now. Like now that's just, I'm your investor, I'm in your corner, I'm here to help. And I also say yes much further down the track. So I had someone call me recently who is a later stage company, but I've known him for the better part of 10 years. He's possibly in the IPO pocket, and he asked me if I would consider coming in and help advising him personally as he goes through this next stage. And that's like very exciting. It's very exciting. Like you would normally jump like, totally, I want to be part of this IPO journey and I've known you forever and how cool is this? And I said, you know what? This is all about chemistry. Let's date for a while. Right? And so we are going to meet up in a week's time, and he's going to come to me with like a problem that he needs help solving, and we're just going to whiteboard together for 90 minutes. And I want us, even though we've known each other, I want him to get to know, how do we problem solve together? How do we see the world? Do we add value? Are we different enough that that's valuable, but like enough that we can talk the same language? And I said, like, let's go on a few dates, and then let's talk about, DTR, defining the relationship. And so that's the one thing that has really changed over time, where initially it was like, oh, I like you, I like you, I like this business, I'll be your advisor. And now it is a much more, the dating process is taking much longer because I take my role very seriously, and it really has to come down to chemistry and a two-way value creation.
We're right on 9 o'clock, but I've got 2 more questions if you've got 5 minutes, Rach.
Yeah, sure.
So second last question is from Kirsten McIntosh. She said, in your opinion, does an angel often leave their knowledge comfort zone to invest?
Ooh, that's actually interesting. So I'll give you the 90-second answer on my investment journey. My first few investments were in my power lane. So as you guys heard from earlier in the podcast, my power lane was around customer experience. And because of Eventbrite, like live events. So my first couple investments, like I think my first 2 were Capiche and Tixel. And so that very squarely was like, oh, I know this space, so I can DD this very easily. And also I think I can like dramatically bend the arc of this company and really lean in. And I'd like to believe that in those early days, I really did help those 2 companies do that. As I started to build my confidence in investing, I started to branch out of my power lane. And the first place I branched into was actually, what do I just want to learn about? Because what a fun way to go deep and learn about something that you're really passionate about. So I invested in Microba because I love gut health and everything associated with the gut. So Microba, and then Mindset, which was a hypnosis app that they have a product called Nerva, where they've gotten IBS symptoms down significantly through hypnosis. So that was like, ooh, I'm super interested in this area. So I'm going to invest my way into mastery. And now, 10, 12 investments under my belt, I understand my investment craft more. And so I go out of my comfort zone, actually, because that's where you'll, pick up on what they're trying to do very quickly. You will be incredibly value add to that team. And like I said, working together, you might be able to that growth curve.
I think you cut out for the last little bit, Rachel. But
it was brilliant, I promise.
I have no doubt it was. All right, final question is from Shane Tracy O'Connell, one of the awesome people that we get to work with at AWS as well. So Shane asks, hi Rachel, is there a minimum investment for potential investors to invest working theory angels? If so, what is it?
Yep. So I don't publicize this, but my goal with working theory is to get as many people investing as possible. So it doesn't matter to me how big or how small the check is. In fact, I have talked a lot of people down, especially if they're just getting started. There is one rule, is that you have to be a sophisticated investor according to the Corporations Act, because this is a wholesale investment. So your accountant can provide verification that you meet those thresholds. That I think is a bummer. Just in Australia, it's a bummer because we want so many people to start dabbling in this investment space, and the threshold to become sophisticated is 250K over income for the last 2 years, or 2 million in assets. And so I do feel upset that there is that hurdle there, but that is the law. And so that is what I follow. As far as minimum investment, I'll say the mode. I tell most people, think about putting 5K against 10 deals. So that's 50K. But there are a bunch of people who've come in less than that because they just want to dabble. And then there are many people who've come in significantly more than that because they're quite sophisticated. So again, it all averages out. No one knows how much anyone went in. everyone gets the same experience. And for me, I'm indifferent to how much money comes in. I'll have a conversation to make sure that you're being thoughtful and smart about the amount that you're committing. But it's more about you just getting this experience, getting the love and the joy that comes from investing and backing these amazing founders, and that you feel, competent and confident to go do it yourself.
Amazing. On that note, thank you once again for all of you for joining us and submitting your questions. And Rachel, as always, great to chat with you. And thank you so much for coming on the podcast.
Thanks, Rohit. Thanks, everyone. Take care.
Bye. Bye. Thanks for listening to episode 130 of the Startup Playbook podcast. As always, full show notes from this interview will be available at startupplaybook.co. I'll be back at 8 a.m. next Tuesday, the 6th of October, with another live episode. And my guest for episode 131 is the co-founder and co-CEO of Huddle and Open, Jason Wilby. I'm really excited about that interview and hope that you can join us. But in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.